So China never lacks of drama regarding its economy and financial market. Over the past few years, people were concerned about China's housing market, rising debt, shadow banks. It seems right now the new flavor of the year is the trade tension, trade war. So we have very diverse panel from all corners of the world and from both public and the private sector. So they will shed some lights, help us to gain a better understanding of the situation. So I'll start with Yao-Wei and Dan Hannah. So we all see China's economy has slowed quite a bit, right? From 14.2 a decade ago to right now in the low 6%. So I want to see, in a relatively near term, how much of this slowdown is due to the trade war? How much of it actually is made in China because of domestic policies, because the tighter deleveraging policy started in 2016?
Okay. Actually, I think if we were ever to quantify this kind of thing, more than half of the slowdown, or I would even say 2/3 of the slowdown was due to, or so far have been due to the domestic factors, especially the financial deleveraging project the Chinese government started since the beginning of last year. As a China economist, I think the key indicator or lead indicator for me is to look at the credit growth. And you can see very clearly the credit growth in China started the deceleration not this year, not because of trade war, actually because of that. Because the Chinese government tried to limit the credit coming out of the shadow banking system. They try to diffuse or reduce the systemic risk or the systemic linkage between the formal and the shadow banking system. And also there is another big part of the debt cleanup. Well, actually two other parts. One is the state-owned enterprises, reducing excess capacity. The other one is limiting the local government financing vehicles in borrowing and putting to the infrastructure, wasteful infrastructure. So all these things actually started to bring down the economy before the trade war impact hit. But no doubt, there is definitely impact from the trade war, and you can see very clearly in the very sharp slowdown in the export growth. But actually, recently, the export growth somewhat stabilized at a low level. The more damaging aspect of the trade war is actually not in the trade flow. It's actually the manufacturing investment, which has decelerated significantly. And this should be the more concerning part of the trade war damage for the Chinese government, because manufacturing investment represents long-term productivity. That means if you don't get this kind of investment, you suffer in the long run. So, yeah.
Sit down, how do you see this? Because if the slowdowns are mainly domestic made, it's easier for them to adjust policy to offset the slowdown. If it's due to trade war, it's much difficult to manage, isn't it?
There's two things going on, obviously. So part of it, I think, is as we've just been talking about, the consequences that you've had on confidence. But it's not just a question of what's going on with the level of manufacturing investment. There was also, as part of the issues around managing the deleveraging, there was a change in the nature of the fiscal expansion. So rather than doing credit-financed investment, which was the nature of previous fiscal expansions, so this time, because we need to control credit, we should use tax cuts and put money into the pockets of consumers. They will spend more, and that will create the demand that we will be sucking out as a result of our deleveraging. The problem was, when you have the environment of the start of the trade war, you damage confidence, so you've given those consumers more money. What do they do with it? Put it in their pocket, right? Wait for a better day, figure out what the heck's going on with that guy in Washington. Right? And as a result, therefore, despite what on paper was a fiscal expansion slated this year for almost 2 percentage points of GDP, right? You look at the GDP numbers, nothing happened. There's a deceleration. Yeah? How much of a deceleration? Well, we'll know a little bit more in like 12 hours when we get the third quarter GDP number, but it's possible that number drops below 6. We already know that the industrial production numbers, the August data quarter on quarter annualized, was the massive growth of 0.4%. We might get a number, and that's quarter to quarter annualized. Right? The year-on-year number was sub 5%. So there is a serious slowdown, and that is both a combination of the uncertainties created by the external environment and the issues around the failure of fiscal policy to be an adequate counterbalance to the efforts on the financial side.
Yeah, I think Dan, you mentioned a very important point. We all know the policymakers in Beijing, they are very good students of the global policymakers and economic history. They thought, well, there's a big tax cut in the US, so we should respond with a big tax cut in China too. But now that seems may not be the best policy in such a situation, right?
Again, I don't think they expected to see the level of uncertainty that was injected into the global economy, much of it focused on them. And so it's hard to fault them for that.
Yeah, so right, because of lack of confidence, tax cut comparing with outright spending just do not have the bang of the buck. Yeah.
Correct.
So I have a much harder question for a long-term outlook. Because when people see the economy decelerated from 14 plus to all the way to 6%, now it may be below 6, and do you see the trend continue or can it get stabilized somewhere? And what are the driving forces behind the very fast growth pace in the past and the much slower growth right now and also in the future?
So if you think about the potential growth rates in China, which is essentially the supply side of the economy, right? You've got a slower pace of investment relative to GDP than you've had in the past. You've got a shrinkage in the labor force that we've seen now for a number of years. And certainly the pace of expansion of human capital, the expansion of the education levels in China is also decelerating. All of that points to a picture in which the growth rate that you can generate from the supply side of the economy is more constrained. How much more constrained? Well, if those numbers used to be, you had that period of time of real GDP growth at 10% without, with a current account surplus in that period and without inflation coming out of control. Today, you've got numbers that are probably on the potential side, something between 5 and 5.5, heading for somewhere around 4.5 to 4 over the course of the next 5 to 7 years. That's dramatically lower. That's also consistent with other countries which have seen large periods of growth and then deceleration to something on the order of a third of those earlier growth rates. The complication that creates is the political target to double per capita income over this decade that will end at the end of next year, which requires growth year on year of over 6%. So if your current potential is lower than that and you're trying to hit a higher target, what's going to happen? You erode your current account and or you get inflation pressures. The current account as a share of GDP has dropped by, over 9 percentage points in the last 10 years. You're now roughly 0.5%, maybe 1%. With these lower GDP numbers, yes, you're going to be okay on the current account this year, but if you continue to push it, you're going to need to use other people's money. When you use other people's money, they have other demands, right? And that will change the macro choice set that China will face. So can you change the supply side? Well, you can focus on investment and trying to improve productivity. Again, in this uncertain environment, that's hard to do. So you're left with trying to manage this deceleration as effectively as you can. But it's still got to be a deceleration that's going to persist. And it's not because something's been done wrong. It's because something's been done right. But times change.
Right. This change is quite a dramatic tectonic change. And now we clearly can see the constraint on the supply side. And if China need to manage a decent growth, they need to be much smarter with all the policy reform to improve the productivity. Now we have to see if they have this guts and courage to do these reforms. Now, for us to follow the trade war, especially follow the tweets or photo ops in the White House, somehow I feel we are get lost in the weeds. So maybe we'll take if you take a step back, right? See it from afar, maybe you can have a better view. So I want to ask our friends from Germany, do you see the shock wave of the trade war has spread far enough to Europe. We'll certainly see there's a shock wave in Asia. Do you feel the shock wave all the way to Europe? And for the weakness in Europe right now, how much is mainly European? How much it has to do with the trade war?
If you look at the export data from Europe and from Germany, so far is not much visible from there. So the downturn in Germany the first half of the year was mainly led by the UK. So we have some Brexit impact there, but it is not visible in the hard data that this happens. But looking forward and looking at the expectations and the behavior of companies, they get more and more worried about the outlook for China and the impact from the trade war. And in that respect, I think this is partly there to explain the weakness of investment activity. So there is some uncertainty coming through, and you see particularly in the sentiment in the German manufacturing industry. There's lots of threats coming up, but so far, as I said, it is not really in the hard data, but there is more to come. And I think this destabilization of the outlook is likely to have some impact for not just the German or the European companies. I think it's on a global stage where you have to think about how do companies set up themselves, how do they set their production facilities, and with this trade war being in place, it's much more uncertain as it used to be, and you probably don't get up with the best allocation of capital as it was in the past, and there is much more kind of sunk cost what is in the system. And I think on top of this, what you see then is in the last couple of years, China was the big driver for the export sector, particularly in Europe. This leveraging what was mentioned before contributed to a huge demand for investment goods, for cars and all that stuff. And it is changing, and I think this is not this trade war thing, but it's more a structural change. The rest of the world has to see China in a different way. If you get more on the consumer side, more in terms of services, there will be less exports in this region, and in that respect, China is likely to have a smaller import penetration, and it's probably less contributing to global growth as it used to do in the past.
Yeah, correct. So the impact of the tariff is not just the lost exports, but also the hit on the confidence, on the investment, the disruption of the supply chains, and the impact on the FDIs. It's really the multifaceted situation. So let's continue on this line.
Just one
Yes.
comment on what Jürgen said. I think it's also important to realize, yes, there's a deceleration in GDP, but Chinese GDP is still bigger each year.
Yeah.
And so and it's bigger in relation to most other countries in the world. Because yes, its growth rate is slower, but it's faster than pretty much certainly the DM world. So in that sense, the opportunities associated even with a slower growing China, even with a China in which import penetration is not as high, is still remains substantial. It's just probably not that chart that we had all rising forever, that exponential surge. Right? That has to be pared back.
Yeah, so media are very eager to report a story like that. Because of tariff, exports are leaving China and move to other South Asian economies, such as like Vietnam, Malaysia. So for being in Asia for so many years, so how do you see such an impact of the tariff on that region of the world? And do you see such a production migration at what scale?
It's hard to say the scale. We don't actually have the data, so because part of what's been going on is just this uncertainty itself. People don't know what investment decision to make. So it's the point that's already been made. People for a minute stop. But in Malaysia, which is one of the countries which has a very high level of overlap in terms of what they export to the United States with what China exports to the United States, certainly there's lots of Chinese firms and other firms coming to Malaysia saying, hey, what does it take to invest here in order to be able to try and do an end run around the tariffs that are established vis-a-vis Chinese goods? The complication, and that's also true in Vietnam, that's true in Thailand, so in ASEAN more generally. The complication is that here the US Treasury and the government has taken the assumption that, well, we need to shrink all our bilateral trade imbalances, Well, of course, the problem is that the overall trade imbalance is largely the difference between savings and investment in the United States. And last year's policies were designed to increase investment and lower savings. So the gap was going to get bigger. So if you squeeze on China, it just pops up somewhere else. The complication that then creates is that in places like Malaysia, say, well, hang on, I already have a big trade imbalance, a surplus with the United States. If I get a lot more Chinese companies coming in, right, producing things here that they used to produce in China, then that number's going to get higher, and then the U.S. Treasury is going to come down, or Mr. Trump will wake up and decide it's a day to put tariffs on me, i.e. Malaysia. So there's that problem is retarding the willingness to accept new investment until there's greater clarity. So you got two problems. One, from the firm side, what do we do because we don't know where this is going? And from the country side, we don't know if we really want it, if it's going to have a consequence that simply spreads the pain rather than spreads an opportunity for us to have trade diversion.
That's a really interesting observation. Yeah. So we all know the trade war actually is not just about the trade imbalance. It actually is also a technology war, right? If you look deeper into this. So I don't think the United States is the only place China acquire its technology. And after all, I think the high-speed train is more European than American. So again, I want to ask our German friends, and from your perspective, so how bad is the situation? Is that exaggerated? And why the Chinese only taking US technology but not European technology?
I think they have taken in some areas European technology, but what the Europeans face at the moment is that in the past there were some things what the Chinese copied and they then started to produce with a kind of a lower quality level. What you see now is that looking at some fast trains that they are able to amend these technologies what they got first and then come up with some new technologies on this. So they are in a stage now compared to that what we had before. It's not just copying and coming up with some kind of mass production. They actually start to go ahead and really challenge the Europeans on that front. And I think compared to the US, the European side for the time being just looked at the export market, that they could make some business there, and they were not really aware that there were some challenging things coming up, that those Chinese companies might get to the same level and come up with products being then a competitor rather than just a buyer of those goods. And in that respect, I think there is this kind of awakening in Europe right now, and some companies start to really complain about the ruling system in Europe, that all those Chinese can come up with their products, and when you want to go to China, there are some restrictions in there. But I think in the greater picture, the Europeans want to have this cooperation, and in contrast to the US, I think that we probably will have to define a couple of new rules in order to keep these new balances in the future. I think there is a strategy in the US regarding China. China, of course, has its own strategy, but Europe is not united in that question. And when it comes to technology, I think they're really a bit of this kind of little chap looking at this big scene without having their own strategy coming up.
Yeah, I know. This is an incredibly complicated question, and we don't have time to go very deep on this issue. We have to leave it for another time. As Yao mentioned at the beginning, a lot of slowdown actually is made in China because of much tighter policy. One of it is the deleveraging started in 2016. Of course, now they take a step back right now because of trade war. So I want to ask Kenneth, so we all know China's debt is very high, but Japan's government debt is much higher. And then the modern monetary theory people in the US argues you can spend a lot more. Just let central bank to pick up the tab. So why can't Beijing do the same thing? So what are really the risks of a high debt level in China right now, and how should they respond?
Well, I think one can take comfort that we have not seen a disorderly adjustment because of the debt overhang in China, but I think the underlying pressures still very much remain. By our numbers, after slowing the pace of credit growth for the past 2 years, non-financial debt has risen to as high as 265% of GDP. That's a 10 percentage point increase in 2019 alone. So the debt overhang provides a source of concern because not only is there a risk of disorderly adjustment, there's also a risk of how effectively, how efficiently this credit is being used. If you look at some of the data, for example, the return on assets for the corporate sector has declined since 2010. And in particular, for state-owned enterprises, it's much below that of private firms. And this is important for China because as China continues to slow, as Don mentioned, as it faces pressures from an aging society, there will be a need to raise productivity in order to maintain China's robust growth rate. And if you have a system that's not allocating credit and resources efficiently, it's hard to generate that kind of innovation to support productivity and investment. Now, that being said, I don't think it's when you can compare to Japan or to other large emerging market economies that have similar levels of debt, because in China, there are very China-specific factors that mitigate this risk. China has a very low share of external debt. It's about 15% of GDP, so well below those of other large emerging market economies. So the risk of a sudden stop or capital flow reversal is not really there. China has a large pool of domestic savings and plenty of policy space, both fiscal and monetary, to address disorderly adjustment. And of course, there are capital controls in place that can help provide time to manage the process. But there is a need very much to continue the de-risking and deleveraging to reduce these financial vulnerabilities.
Yeah, in fact, I completely agree. It's really not about the level, but rather what you use the debt for, right? What's the productivity of this debt? And I think it's a really crucial point. So one effort they are making right now is not only to delever the non-financial sector, but also financial sector too. So that's why we see the bank leverage right now have been brought down a little. But when you try to defuse all these time bombs, right? If you're not careful enough, you set off a few. We saw a couple of time bombs set off this year, like at the medium-sized small banks. So I will ask Sally, from your view, so is PBOC doing the right thing, or by being relative, try to delever the banking system, or are they doing too fast, too much at this moment? So will this deleveraging effort in the banking sector set off a chain reaction or cause some systemic risk?
Indeed, the Chinese authorities have stepped up their restructuring of the regional banks this year. So we have 3 cases. The first one being more familiar with you is Baoshan Bank in May. And the second one was Bank of Jinzhou, where 3 state-owned financial institutions became the shareholders. And then the third one was Hengfeng Bank, which in August, reportedly, the central Huijin and the provincial government became also have plans to invest in the bank. While on the surface, these looks quite negative, right? But we actually believe that this is positive for the financial system because it shows that the Chinese authorities are very focused on reducing potential contagion from failing regional banks. So if you look at the Baoshan case, initially when they announced that they would take over the bank, they wanted to impose losses on the wholesale creditors. But then that caused significant risk aversion in the market. So interbank funding for the regional banks and the non-bank financial institutions went up quite curtailed, the funding curtailed. At the same time, the funding costs increased for the regional banks and the NBFIs. So to alleviate market concerns, the CBRC quickly changed their approach and cut down the losses on the wholesale creditors. Also, only 0.02% of the creditors bear losses, and the losses was only about 10% of the net claims. So, in addition, the PBOC also injected liquidity into the system, 430 billion, to bring down the interbank rate that has shot up because of the concerns over the regional banks. So you can see that the regulators and authorities are very determined to contain the contagion. But indeed, we expect more of these small banks to fail because the central government, as you mentioned by many of us here, is very focused on reducing shadow banking in the long run. And actually, a lot of these regional banks are involved in these shadow banking activities. However, we do not expect a systemic banking crisis or financial crisis because financial stability is still the overriding priority for the central government, for the Chinese government. And they would continue to provide support to the banking system, but it would be more in a more adaptive and ad hoc basis rather than following a formula. But they will be more selective. We believe in the way that they support the small banks. So the 3 banks that we talked about here are actually not really small. They're by definition mid-sized regional banks per the definition of the PBOC. But then then the question becomes where do they get the resources? Indeed, the Chinese government have various resources they can mobilize, including the central and local government, the sovereign wealth fund, the central and local distressed asset management companies which were involved in some of these restructurings, some of the more financially stronger local government-owned enterprises as well. So with that said, the ability for the authorities to contain the bank distress will depend on the speed where they find out about the problem, as well as whether they decide to provide resolution or not.
So I think myself, I understand China pretty well, but I myself am also quite confused by one of the PBOC's policy stance, right? PBOC, you said, is closing down the shadow banks because it's just too much. Then when you close down shadow banks, both the deposit and lending are moving back onto the formal bank's balance sheet. So the formal banking sector needs more funding, okay, needs more capital. But at the same time, the PBOC is also very cautious in its monetary easing, right? They have done something on the quantitative side, but very little on the price side, okay? I just mentioned to Yao during the conversation. In the past year, how much PBOC has cut the interest rate? By a total grant of 11 basis points, right? 6 basis points plus 5. And when all the major central banks around the world is going through another round of easing, so why is PBOC so cautious?
Yeah. Well, the PBOC is probably the least dovish central bank right now in the whole world. Yeah. I would even argue they didn't cut policy rate at all. If you look at interbank rates, 7-day repo rates, they are pretty much at the level, the same level as the beginning of the year. I think this is very much related to the discussion we have had so far. The trade war, the debt concern. I think all this makes the Chinese government realize the more important thing than a arbitrary growth number in the short term is to how to make the system sustainable in the long run. Right? So the flip side to the story of manufacturers leaving China is actually 70% of European companies, 60% of American companies say they're still going to stay in China because China has demand. So the Chinese government now are looking at the policy mix, thinking about the macroeconomic framework somewhat differently from the past, which is, when they gauge the policy scope, is not how much room they can cut to zero. If you look at that, PBOC can effectively bring 7-day repo to zero, which is right now at 2%. So they have a lot of scope, right? You can argue that. You can argue, the fiscal deficit official number at least is less than 3%. But they look at the measure the policy scope by looking at the overall level of the debt, which is high, by looking at how much risk there is, for example, in the shadow banking, in the small banks, in the housing sector, also in terms of the CPI and the POC inflation. So look at all these things, they judge that they actually don't have that much scope from a long-term perspective. So they're very careful how much to use it, how to use it, when to use it. And looking at the situation right now, sure, the growth has slowed down, all that. But earlier, we did discuss, the consumption actually is relatively okay. The service is actually not too bad. So in some way, they're still saving bullets. But I think another very important thing about the PBOC as well as the Ministry of Finance is that they're changing the way they ease the economy. Right? They're much more focusing on allocating the resource to the private sector, to the households, and hoping they will this time bring the cycle around. And in the past, it was always the state-driven infrastructure investment. Why this shift? Because they think if you let the private sector to lead the cycle, it's more efficient allocation of the resource. This is in the same spirit of controlling the debt risk. So that's why the PBOC cutting rates very limitedly, but they have done a lot of targeted measures, right? Targeted measures to help the private companies, to help the SMEs. They've done a lot of, the Ministry of Finance similarly, they use tax cuts, but not so much the infrastructure, right? You look at the infrastructure growth this year, it's barely faster than the pace last year, which was the slowest rate ever. So not only they have done limitedly, they're doing things very differently, all because they're looking at the structural issues.
But one of the complications they've got, it's a conundrum, that if you want to have effective allocation of capital, you have to align risk and return. And in the discussion we just had about how this small banks that went under were handled, 0.2% loss, right, is separating out the funding side of the financial institutions from the asset side. And if you don't have those people who put the money in the bank at risk of losing it if the assets aren't properly allocated, your system will not efficiently allocate the capital, right? So the unfortunate situation is if you want to actually break down the implicit guarantee, people have to lose money. But if investor A loses money in commercial bank B, investor C and D, E, F, G, all the way to Z, goes all the other institutions and starts taking out their money. But that has to happen, right? In part, that's the only way forced loss generates some period of upset if you want to align those two things. But that's complicated, right? Because that's a fall in GDP growth, right?
There's a balance to strike.
For the small banks, we expect, not everyone would be supported. They would be more selective, and if they're not systemic important, they will let them fail. And there would be more burden sharing by the creditors. That's what we expect.
So I have one more question for you for this slide. So in late December, PBS Governor Yi Gang was giving an interview talking about great achievement in the past 70 years. When I was pressed by a journalist, he made the following comments. I read it to you. He said, "We are not in a rush to roll out massive rate cuts or quantitative easing like some other central banks. We should cherish normal monetary policy room and extend normal monetary policy as long as possible." That's, I think, he made in the last week of September, just a few weeks ago. Now, but when I saw this, and then I saw the trade negotiations, so-called phase one, came out the last week. That must be positive for the RMB exchange rate, is it, right? Because the tariff, right, is a negative shock to China's economy, which is negative on RMB. And in an ideal economic system, RMB should depreciate in response to the tariff. On top of it, the domestic economies are weakened. Then at the same time, PBOC is relatively hawkish, didn't cut the interest rate. And there also seems an agreement on the currency between Washington and Beijing. So how do you see the future of RMB? Don and Yao, you want to?
I think that China has allowed for greater exchange rate flexibility in recent years, and this has allowed monetary policy more autonomy to address domestic conditions. So although they did not cut the policy rate, they did inject liquidity through reducing the reserve requirement rate by 350 basis points. As you mentioned, they introduced targeted lending facilities. I don't think it's a question of monetary easing. It's more about making sure that liquidity goes to the place where it's needed the most. And the system is not functioning well in that regard. And I agree that it does have to do with the risk of counterparty that has been introduced into the system, the fact that China does not have a rules-based resolution framework like in other countries that allows for more predictable restructuring of banks. And for a healthy financial system, it is important to have defaults. That's how you have discipline in the markets. So there's still a lot of work that needs to be done to produce that system for China. But I don't think monetary easing is the way to go. Bank loan growth was around 13% on average since 2016. That's still faster than nominal GDP growth. On current trends, non-financial debt will continue to rise unless there's more effort to de-risk and de-leverage. And that's a concern for many of us.
There's one other bit of easing they did was also a reformatting of the
Yeah.
formulation of the lending rate of interest.
Yeah.
Which effectively lowered it marginally. Again, not very much, but that is a shift.
But
I think
first,
there was a risk.
Oh, now
probably
you
at
want me
some
to
stage.
answer the unknowable question of the
yeah, the
renminbi?
Jürgen first, and then you.
But there was probably a risk that this weakening of the RMB might be too fast and too much more tensions coming up with the US side. So I think in that front, they probably did not want to fuel this whole debate even more. And in that respect, also what we had in the phase one thing might be some concession in that direction.
Yeah. Because when you read the chart, right now the morning fixing for RMB is almost a straight line, and then the ending spot rate still bump around, and then the fixing is fixed stronger than the closing spot of the previous day. So it looks like it managed. So what do you see the outlook of RMB?
Actually, we've done this analysis trying to match the level of the exchange rate, bilateral RMB versus US dollar exchange rate, with the level of the tariff, and we found that actually, very interestingly, the tariff is indeed the most important factor right now for the currency. Well, since actually the starting of the trade war, meaning that the PBOC has allowed the RMB to depreciate in line with the tariff, but not more than the tariff. So at least, our analysis seems to show, the RMB depreciation is being used as a defensive, reactive tool to this whole trade war. It doesn't mean that RMB can offset all the trade war impact, but that seems to be the trajectory. And I do think, in the short term, very short term, if we're talking about in the next 12 months, still, it's going to be the tariff. If we're gonna luckily reach a phase one deal, involves some reduction in the existing tariff, then the RMB can go back to below 7. But if the tariff were to escalate, according to analysis, for example, if the tariff initially scheduled for October 15, now delayed, if that still happens, it actually responds to the exchange rate level at 730. So I'm not saying that PBOC will allow the currency to go that far, but that's the direction if things get worse.
I agree completely that this process of, if you look at the movement, not just the levels, but the volatility of exchange rate, you get higher volatility around moments in which there's changes in expectations about the path of tariff movements or the actual tariff changes themselves.
Yeah.
So this is clearly an element of the negotiation, right, that's going on vis-a-vis the United States and China on the exchange rate. And of course, it's one of the elements that is included in this phase one deal, the details of which are still sketchy.
Yeah.
I don't have anything to offer per se on the
Yeah.
exchange rate, but quite a lot of Chinese corporates have issued debt offshore in US dollars. And given the depreciation of the RMB, they needed to pay back in US dollar. That's going to add to the burden if they don't have any hedging strategy in place, or especially considering the capital control and also the ability to obtain US dollars offshore. Sometimes it might not be as easy to think about refinancing. So it's something also we're watching quite closely.
Yeah, glad you mentioned this because it's a relatively obscure but it's a very important point because data is not easily observable. But that's, I notice it's just a very large amount. There's so many considerations behind the RMB policy, the treaty negotiation, the concern about capital outflow, but also the outlook of the current account, right? As you mentioned, China's current account dropped from 10% of GDP almost to nothing last year and bumped back a little bit. So I want to ask Ken, so what's your outlook of the current account? What are the drivers behind this?
No, I think that's a remarkable story that the surplus has fallen from 10 to, in our projections, 1% of GDP this year, and over the medium term by 2024 remain around 0.4, so slightly positive balance. I think this is both a reflection of structural and cyclical factors. Structural related to progress in rebalancing, but also increases in outbound Chinese tourism and a lower goods surplus, but cyclically related to commodity prices and also recent policy support. I think this has very important implications for the global economy and for China as well. It's not that China will necessarily need to have financing for the future for a current account deficit. we're projecting near balance. But as China continues to mature in age, there will be pressure domestically for the large pool of savings Chinese households and corporates to diversify their investments domestically, but also overseas. And I think this is also part of the driving force behind opening up further the financial sector to allow for greater two-way flows. But to do so, you need to have a more robust, stronger financial sector that can better manage these larger capital flows and the related risks. So I think that's a very good positive step for China.
Yeah, I think that probably the reason to now open up the financial sector a little bit, especially welcomed the company that ratings and the indexing is all going to this direction, right? So we have about 30 seconds left, and any final words so that our audience can take home after this conference?
Maybe I think obviously the Chinese government is doing many things at once. It's a great balancing act at the highest level, but I think overall the Chinese government are moving things in the right direction, especially given they're really emphasizing much more on containing the debt risk, diffusing that risk. But when you start to diffusing the risk going to be exposed. So I do think the next 3-5 years will be particularly challenging for the Chinese government. But if they pull through, the Chinese economy will be in a much better place.
And you talk about opening up of the financial sector. Just one thing that while it looks really good to many of the foreign financial institutions that they can now operate in China, I think it's still they need to think about the brand recognition is still not as good as some of the domestic players that are already in place. The opportunities probably will lie more in those sectors that are more underserved, like insurance companies or asset management companies that are that the products offering might still be less sophisticated. While for banks, there are thousands of banks already in China, and also the foreign players will have to think about is they are also competing with the technology giants in China, where the BAT, the Tencent, Alibaba, and Baidu, they also are already deeply involved in the financial sector. So how they integrate or use technology more to play in China, I think something that they need to think about.
So we're running out of time. Thank you so much for the very lively discussion and your great and unmatched wisdom. Thank you.
Thank you.
Thank you.